Hey, what's up, guys? We are here for day three. Wow, my hair's all over the place. We are here for day three of the new finance channel, and we're finally going to go over kind of what we're buying and why, and kind of explain a little bit about what dividend investing is, or dividend growth investing, or dividend income investing. We're kind of taking like a total swoop, like all of it, right? Um, so first, I mean, at its basics, right? A lot of people don't even know what stocks are. So let's just start there, right? A stock means that you own part of a company, right? I think that that is not stressed enough when people are saying, "Oh yeah, this stock looks good." Like, would you want to own that company, right? So that's a big part of this whole thing. Like everything aside, like pick a company that you believe in. If you want to be a part of a certain company, or you're like, I would love to own that, or like the guy who owns that company must be making bank. Like, that's the stock you buy. You can buy part ownership of the company. So all those movies are like, you grow up watching, shows and whatever, and they're like, we gotta pay the shareholders. That's all about the shareholders, right? Like, we can be those shareholders. We can be those people that get paid out or whatever. So a lot of companies do, and a lot of companies don't pay dividends. And what a dividend is basically the payout to the shareholder, right? So for you owning a chunk of the company, you're getting paid, monthly, quarterly, annually, whatever the structure is of that company. That's what dividends are, right? So to me, a big portion of why I believe in dividend investing is because if a stock goes up or down, right, what's that based on? Is it based on how hyped up a product is? Is it based on, memes, diamond hands, whatever it may be? Or is it based on that this stock will pay you a certain amount every month to hold it, or every quarter you're going to get a check? Like, that to me is more valuable because it's a lot less speculatory. It's tied to something. It's saying, all right, if I give you $10, you're going to give me $1, every year for the rest of my life. That's a pretty good deal, right? Like, that is a pretty good deal, especially if you reinvest that dollar, right? And then so it kind of snowballs, and it just keeps moving. Like, you get paid a little, you just add it in back into your investment. Now the amount of stock that you have grows, and your dividend checks grow, and that's the whole thing. And then one day you say, I've had it. I'm not going to put it in anymore. I'm going to take my eight to $10,000 a month, and I'm just going to move to Fiji, and for the rest of your life, you can just take your dividends and live in Fiji, and laugh about the times that ate hamburger helpers so that you could save money to invest in SCHD. So that's kind of the point here. We're going to dive into some of the stocks that I like, some of the stocks that I've picked, and some of them are like, I just like them, and I'm sorry, but there's reasons why I do. But some of them are like, how do people not talk about this? How do people not know that you can, you know, beat markets with ETFs? Like that, it's crazy. Like, we're going to take a look at that. Let's dive right into it. All right. So here we're on Seeking Alpha. This is a awesome program that, or website, I guess I should say, that's basically allows you to get more in-depth information. It pulls articles and stuff like that. But for financial data, it's probably the easiest place to see everything in one shot. But I want to start by pointing out these are the stocks that we sort of briefly mentioned um, yesterday. So, first one on here is we have BlackRock. They're like the massive holdings company that owns lots of shares of lots of things. They've been doing pretty well. JEPI. This is JP Morgan Equity Premium Income ETF. So the cool thing about JEPI, JEPI pays you every month um, for holding their ETF. So, for every share of JEPI, you're basically expecting to get about $5 back, and you can see the price of the stock. Uh, Sorry, $5 back over the course of the year, and you can see here the stock is only $54. So, killer returns. Even if the market doesn't go up or down, you're still making like 10%, 11%, which is stellar. MPW, this is probably the most high risk thing that I have in my portfolio right now. Medical Properties Trust, they are a real estate investment trust. So they own medical properties, they own like hospitals and stuff. Stuff that they are buildings they rent out to like massive hospital corporations and things like that. Right now, their stock is very, very much down. And the like big investment people are like very split on what to do with this thing. To me, we're still in the stage where you know we can have a little bit of fun with this portfolio. My goal is to not be having fun with the portfolio and is to make money, but we'll go into why I like the opportunity that comes with this, and I'm not afraid of a little bit of risk on it, because again, this is really the only thing in my portfolio, or this portfolio, that I would say is like more on the high risk side of things. um, but we'll get into that. So ticker symbol O, also known as Realty Income Corporation, also known as the monthly dividend REIT. That's what they call themselves, something like that. Um, so another real estate investment trust. They buy like huge commercial properties. They buy single families. They have a gigantic mixed portfolio of all sorts of things. One thing that's kind of cool is they own the Encore at Boston Harbor. So like, yeah, they're buying that kind of stuff, like big ticket items. So that they pay you a dividend every month. So when they get their rent checks from all these companies, they pay most of that out to the people who own the shares. So that's great. I've had it for a long time in multiple portfolios. So that's kind of a staple that I like to invest in. We have Pepsi. So everyone knows Pepsi, right? Um, yeah, I mean, there's not much to say about that. When you look at all the companies that Pepsi owns, guys, Pepsi is not just a company that makes delicious soft drinks. Like they own, like, you know, Lay's chips. They own like just so many things. It's crazy. Like you really like the more you look into Pepsi and how much stuff they own, it's like whoa. Um, Procter and Gamble company. Procter and Gamble makes like everyday stuff. Most likely you can pick up like a shampoo in your house, turn it around, it's gonna say like Procter and Gamble. um, and so SCHD, this is Schwab's um, dividend equity ETF. It's basically like their market dividend paying holding, right? So like you can buy SPY, which is basically the S&P 500. That's pretty widely talked about. Ticker symbol SPY. This is Schwab's. Like we all know Schwab, like Charles Schwab. This is their dividend paying holdings. And then the last one, T, that's AT&T. We all know AT&T. They do telecom and all that stuff. Company's been around for ages. So, most of these people have heard of. And going back into when I was saying earlier, like when you invest, you want to invest in something that you're like, wow, those guys must be killing it. Or that company is probably really safe for the next 15 years, right? I can't think of a company that I believe we will still use more than Pepsi or like Procter and Gamble or AT&T. Like doesn't matter if the world's collapsing around you, you need a cell phone. You know what I mean? like maybe the market crashes and we're all broke, like I'm still gonna buy cheap shampoo and like that's got Procter and Gamble's name on the back. Like we're gonna need soap. So like Procter and Gamble makes literally everything imaginable. Like um, you know, Realty Income Corporation, we're gonna need places to live, right? So we'll get into these a little deeper. But first, I want to start with SCHD because I showed everyone the contributions I was going to be making. SCHD is going to be 10% of what I put in, and then Realty Income Corporation, that's another 10% of what I'm putting in. So, like these two right here make up 20% of what that portfolio is going to look like. So, let's take a look at SCHD first, right? So, right off the rip, right? We can see the 1 year chart of this thing. It's down 6.41% on the year, right? 6.41% is way better than like pretty much everything. I mean, we've all looked at our 401ks or we've all looked at the market. We all know that things right now are bad. The good thing is they're not that bad for SCHD, right? Um, just taking a look right here in the middle of the screen, right? We show that they do pay a dividend quarterly, so they're paying out the shareholders every quarter. That they pay 2.5 or $2.56 per every share that you hold, which is 3.39%. So, right off the rip, even if the stock goes down, I know that I'm at least getting paid back 3.39, which closes that gap up a little bit of the annual loss. So it's a pretty good thing, pretty safe buy, which is nice. I want to take a look here at the dividends. It's always good whenever you see A pluses, but I don't read into that too much. We want dividend growth. So here's why dividend growth is important, right? If I buy a stock today and I know that it's going to pay me $1 a year, I want to know that next year that same stock is going to pay me $1.05, right? Because as you're buying stocks, that's great, but you want the stocks that you bought at the beginning to be paying you more and more and more and more every year. So that's why dividend growth is super important, right? Because that old money that's just sitting there is just going to grow and grow and grow. Here's a really good example of that dividend growth, right? So this is how much you would have been paid out if you bought the stock or ETF, I should say. I'm sorry if I call an ETF a stock. It's going to happen. So if you bought SCHD in 2011 when it first came out, you would have made 12 cents. And as you see, that payout grew 81, 90, $1.05, or sorry, yeah, well, yeah, $1.05, $1.15, $1.26, $1.34, and you just see it goes all the way up. So that initial money, if you invested, let's say 2 years ago, you're making 56 cents more per share. And like, doesn't sound like a lot, but that's pretty good. That shows that they're basically growing their payout. Like they grew their payout by 13%. That's massive. So pretty cool stuff there. You can see the earnings on this little chart. Very simple. Like if a stock or ETF's payout is going up, that's something that you generally want to buy. So like pretty simple, right? Going over to charting, this is where it gets even crazier. So we have the S&P 500, right? Over the past year, the S&P 500 was down 19.65%. So that's what I'm talking about when I say like everyone knows the market was terrible last year. It was not good. But for every $1,000 you put in, you would have saved an extra $130. Like that's pretty good. But and then when you flip it and you go from price return to total return, remember those dividends are paying you back. So we were talking about that earlier, right? Coming over here, you have a 3% loss for the course of the year. That's pretty good considering times were very, how I say, tumultuous. It was not a good thing. Here you have on a 3-year chart, They basically perform the same, but you get that extra safety from those dividends in SCHD. So over a 3-year time frame, you're actually out earning the S&P 500. So that to me is really appealing. Like seeing that when the S&P 500 went down, SCHD just kind of didn't. So that's really good. So that's why that one's like number one in my portfolio. Will be for a long time. So coming over here, we're going to go to O, which is Realty Investment Trust. So here's another one where obviously, again, it's down, which is a bummer. But get that thing out of here. You can see here that it is down 11.78%, right? So not as bad, or at least not as bad as the S&P 500. So beauty of this one, we're going to come back to this box over here. We can see that the dividend is paying 2.98, which is a 4.7% return. And that's going to pay out monthly with Realty Income. So, the return over on this side was worse than SCHD, but the payouts for holding the stock over on this side were higher than SCHD. So a little, kind of convenient they end up being kind of similar. We're going to look at the dividends here. We have dividend growth again. So this thing's been around for forever, by the way. This thing's a machine. So the first thing we want to see is there's no negative growth. They've all, except for 1996, sorry. But aside from 1996, the dividend has always gone up. That's really, really important to me. If you have a fund, a real estate investment trust, or whatever that's gone through 2008 and still increased the amount that they were paying people for rents on their real estate, that's a really good sign. So that's one of the reasons why I really believe in this as a product for investing is they're paying people out every single month. And then look, like here's 2005, 2006, 2007, 2008. This number keeps going up. So while the world was collapsing and everyone was losing their houses and stuff was getting foreclosed, here's this random realty company with a bunch of houses renting them out, just making bank and sending people checks. Like awesome. So I love that. Going over to the chart here, similar situation with Realty Income Corporation. It did better than the S&P 500. When I flip this to total return to include investing the dividends, again, outperformed last year. If I go back to that 3-year chart, not as much growth as the S&P, but I do like those dividends getting paid out, buying more and more shares, like very, very quickly. So, great investing tool. It kind of flip flops a little bit here and there. You have during like the beginning of 2020, it was massive, and the real estate market's kind of been a little meh since then. But yeah, really good to look at. Pretty awesome. Those two are the heavy hitter giants in basically all my investing portfolios. But so next we'll go to BlackRock. BlackRock is something that I decided to invest in for a couple of reasons. One, they are a mega giant. Like if you look at any portfolio managing tool or any news article on who's buying what shares of things, it's always like Fidelity, BlackRock, and State Street, and BlackRock seems to have more shares of everything, just because they own so much control in the market. That's why I think BlackRock is good to add. Also, it is down 22.45% on the year. They're a financial mega giant going into like bad times, so I get that. But they do have a pretty good dividend. at 2.75%. Again, they're just massive. If we go into their dividends and we check out their dividend growth, you can see here that they've basically pumped their dividend payout every year, except a couple where it stayed the same, but no decline on their dividend growth. And you can see that their payout is increasing by 18%, 13, 10, 9, 20%. Like they're definitely dedicated to growing their dividend payout to their investors. Like you can see that hands down, which is awesome. So, you know, again, putting in money now and then in the next 5 years, if my dividend payout doubles, because that's what it did, that's what it's always done. Um, that's a great thing to be invested in. I think charting wise doesn't look that great because they didn't do that well this year. It's not that far off of the S&P 500, but at least you get those slightly higher dividend returns as opposed to investing in SPY, or which is the S&P index that most people are in. Um, if you're looking at BlackRock over the past 3 years, they do outperform the S&P 500. So, it's important to stress dividends, but it is also important to have a little bit of growth in your portfolio. I don't want to short myself in earnings by not including something that has some growth. So here we not only get a dividend, which is better than the or better than SPY's payout, but we get that growth aspect too. I mean, it's pretty similar if you go out a long time, but again, like past 3 years, I, I like it, right? I like it. Um, so that's BlackRock. Jeppy. So Jeppy is a relatively new investment that is extremely exciting to me. This is JP Morgan's equity premium ETF. You can see it right up top. They are down 13.6% for the year. This is such a cool fund, guys. So it's a covered call ETF, basically similar to like QYLD or any of those. What that means is they own shares and then they sell options to buy it and take commissions for selling and pay you on it. Basically, like way oversimplified. We'll do like a whole video on that and how that works. Um, but the thing that's crazy is they are paying monthly dividend payments. So every month you're getting paid out, and they pay $6.36 a year on a $54 investment. So they're paying right now a monthly dividend that equals 11.68% per year, right? Massive. And like, look at the articles on these things. Like, the volatility loving cash cow. Like, that's a great title. I love that. 11% yield monthly payer versus alternative S&P high yield funds. Like, dude, people are all about this. There's a big buzz in the investing community about this. And the charts are excellent. So for one, Jeppy's outperforming the S&P 500 right now, even just without dividends, right? So without dividends, it's outperforming the S&P 500, which is stellar. Then we go to total returns. We add the dividends in. We're only down 3.3%. Very similar to that SCHD type differential, except the wealth you're gaining in this is from being paid monthly. So you're buying back in monthly, which is great. If you look at the 3-year chart, you're still outperforming the S&P 500 on a dividend paying monthly ETF. Like, awesome. Most of these things like QYLD, let me just put in QYLD as an example. Hold on. So this is something that does the same, but because QYLD is so focused on making the payments and not locking any potential growth, right? You see that QYLD is a great place to not really make any money, but get paid out largely, right? So here, for example, in the past year, QYLD down 19.26%, and that's total return. That includes getting paid out your dividends. So, there's a reason why I was saying the other day that I am selling my QYLD shares to invest in JPQ, or sorry, JEPQ, which is another thing like this. But like, I think that JEPI, this right here, is an awesome opportunity to very quickly grow a like a big basket of shares that will pay you out largely. So that's Jeppy. MPW. This is the risky business right here, and boom, there it is. So we're down 52.51% for the year on MPW. We got all sorts of stuff here. We got people saying buy, strong buy, hold. There's a lot of chaos around this. So basically, Realty Investment Trust, working with hospitals, they basically own a bunch of hospitals and medical properties. One of their biggest tenants, one of the people who rents from them, was having financial trouble, and that's why the stock is down. So it looks like a couple days ago they just came up with an agreement with their people that were renting, so that's exciting to them. You can see that here in the news, like medical property stock jumps after its largest tenant extends line of credit, stuff like that. So here is why I like MPW. One, we're buying it like mega cheap. Like, it's $11. This thing floats around $23, $20, 10-year growth rate. If I look 10 years ago, it hovered at like 12.8, 14, 15, 16. If I go max, it's a $14, $15 stock. It should be, right? So there's definitely some upside to this. If we look at the dividends, oops, I keep doing that. So if we look at the dividends, we do have 1 year, which was 2009, where they did have to cut their dividend a little bit. But aside from that, you can see that they learned from their mistake. They're slowly growing their dividend back year over year, and they're continuing to pay out that dividend, even while they're going through this thing with their number one rental tenant is like a little dicey, or at least as far as what I've gathered, like looking at all the stuff. So that dividend keeps growing. I'm just going to go back to the summary real quick. So they're paying $1.16 per year on an investment that's $11.14. So that's a yield of, they're paying out 10.4% of whatever you invest right now, which is it's ridiculous. It's completely ridiculous. Like, that's so good. The stock, it did drop down to 10.2. So I've actually bought in somewhere in and around here in one of my personal portfolios. So like, I'm already seeing gains on this thing of 10%, and it hasn't even been like a month, so it's like, it's pretty good. But anyway, so we're going to ride that out and see how that goes. If I look at the charting, this is not going to be an effective chart as like, hey, we should invest in this. This sounds great. Yeah, it got smoked. It's really not good. But total return, slightly better, still bad. If we go to a 3-year chart, bad. 5-year chart, over 5 years it's made money actually, so that's not that bad. But still not good, right? Just not good. But we're going to jump into it. It's 5% of the portfolio for now, and we're going to see what happens with that. I'm actually pretty excited about it. Pepsi, right? Oh no, we already did Pepsi. No, we didn't do Pepsi yet. This is Pepsi, guys. I don't know if you see it right off the rip, but Pepsi is up for the past year. Through 2020, the market crashing, people losing jobs in the tech industry. Elon Musk lost $200 billion, right? Pepsi is making money. Like, and people are still complaining about it in the news. I don't understand. But Pepsi's making money. They're printing, guys. So if we look over here, we have the dividend rate. They're paying 4.6 or sorry, $4.60 on 180 bucks for a yield of 2.55. So it is one of the lower yielding stocks that we have here, but it is one of the higher growth stocks that we have on here. Over the past 5 years, Pepsi is up 53%. That if that's not killing the market, like I don't know what is. They're doing awesome. When we look at the dividends here, we look at the dividend growth. So they are what's called a dividend king, which means that they have increased their dividend payout every year for the past 50 years. All right. So you can see here that, like, if you bought this for in 1989, right, when I was born, so you could have bought this when I was born. You're getting paid $12.50 a share. Now every one of those shares is earning $4.53. That's insane. Um, you can see that their payout growth is 6%, 5.5, 6, 5.7. Like, they're growing their dividend notably. And that's awesome to see. If you go to the 10-year, 10 years ago, this stock paid out $2.24. Now it pays out $4.52. So in 10 years, that's more than double. Yeah, that's awesome. Like, super, super strong stock here. If I look at the 1 year price return, well, they made money instead of losing money like everybody else. If I go to the total return, they made a lot of money instead of losing money like everybody else. Like, guys, 7.43 is like what you use to estimate what your retirement will be based off the average return of the S&P. Like, this is not like 7.4 is really high when the market's coming down. And if you look at this over 5 years, it's outperformed the S&P 500. Over 3 years, it's outperformed the S&P 500. Over 10 years, it outperforms the S&P 500. If we were just buying stock in Pepsi instead of buying root beer, we would be pretty up. Like, it's pretty good. So yeah, definitely on the Pepsi train. We'll cover Pepsi sometime. Maybe like next week. We'll do a thing about like how massive Pepsi is, because it's mind blowing. Like, it's completely mind blowing to me. All right, so sorry about that. The recording just stopped conveniently before we go into Procter and Gamble. So Procter and Gamble, massive company. They own a lot of stuff. So I think it's a good opportunity to take in. While it's down, it doesn't usually drop very much, but um, it is down. So Procter and Gamble, massive company again. Everyone needs shampoo. We all need soap, right? If you can flip around anything in your house, it probably says Procter and Gamble on the back. That is sustainable, in my opinion. But so we are down 6.89% for the year, so not bad. Coming over to this side right here, they pay a 2.41% dividend, which is 3.65. So $3.65 on $151. Lower yield, not too bad, but if we go back 5 years, these guys are up 67%. So that's like massive growth. Massive. The fact that they're paying a dividend at 2.4% is fantastic. But yeah, definitely a company that's growing, and it shows. Like, we all know the name Procter and Gamble. So if we go into the dividends, just like Pepsi, they are what's called a dividend king. So again, they've grown their dividend payout for the past 50 years. So, you can see here they're paying 10 cents. It goes up, 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 all the way to today. And, their annual growth of what their payout is 6%, 9%, 5.52, 4, 3. Like, these guys are pretty good at increasing their dividend payouts. And again, tale as old as time right here. You can see that the money goes up. If I know that every year, if I never invested again, I'm going to get paid more money than I did the last year, that is pretty good. So, now comparing Procter and Gamble to the S&P 500, because that's generally the mark. Are we outperforming the market? In this case, yes. Yeah. So Procter and Gamble lost 6.89% versus the S&P lost 19.65. If we go to our total return, which includes the dividends, you can see that spread is even wider. Procter and Gamble lost 4.57% versus 18.32. If we go back 3 years, you can see here that Procter and Gamble actually had a better increase than the S&P. If we go back 5 years, you can see that they blew them out of the water, which is awesome. 10 years, not so much, but still close. It's pretty good. But yeah, I mean, 5 year, 3 year, 1 year, it seems better. That's a good sign for me. Plus, again, those dividends, they keep raising them every more. So if I can make a little bit more money every year, that's the goal, and capitalize on some of that growth. I mean, again, looking at the 3 year chart, 31%. Looking at the 5 year chart, 91%. That's like almost doubling your investment in 5 years. That's stellar. So I'm all about that. And then the last one is at&t. So at&t is up 30% this year, which is just nuts. They cracked the code this year, and they blew everybody out of the water. So they're up 30%. The stock price is $18. As we come down here, they're paying a 6% dividend, right? So they're paying out $1.11 a year. I mean, that's huge. If we look at the 5 year return, they are down. So maybe it goes up and it stays up. That's what we hope. I hope. But yeah, I mean, that dividend is massive. If we look to the dividends, growth history, this is where at&t does get a little choppy for me, right? A little choppy. So they had good growth, and then in 04 they cut their dividend back a little bit, right? So it was 78 cents and it went to 71 cents. So that's not great. But then in 2022 they cut their dividend, so they actually paid out 6 cents less than they did before. So that's not great. Definitely not great. Hopefully they can get past that, but they are still paying a very high dividend yield. So they're paying, pretty high, but look at what they used to pay. I mean, 12%, 12%. Look at this. Even last year, 9%. Hopefully it can kind of inch its way up like that. That would be fantastic. But again, it's at&t, guys. Like, this is a company that, it's at&t. Like, the world can't live without at&t, or at least the US can't, I don't think. So here is the at&t versus the S&P 500. The 1 year chart just looks ridiculous. I mean, come on, guys. This looks crazy. So it's because it's up 30% and S&P is down basically 20%. It's like a 50% swing. That's nutty. And then you go total return, you add in the dividends, at&t was up 39% this year. Like, that's bonkers. So yeah, this definitely performed very well the past year. If we do the 3 year chart, well, back to reality. So not great, kind of stagnant here for a little while. We looked at the 3 year chart very briefly. You can see it wasn't that good. It was down like 15%. 5 year chart, not great again, but again, not great. It is a good, oops, I don't know what I clicked. Let's try that again. All right. It is something that right now is seeing growth. If they bring that dividend payment back up, that's a big opportunity for more growth or further growth. So that's kind of what I'm banking on there. There is the other competitor, which is Verizon, right? So in looking at at&t versus Verizon stock, Verizon actually performed worse than the S&P 500. I'll include the dividends over the past year. If I go to the past 3 years, they performed worse than both AT&T and the S&P 500. If I go 5 years, they performed worse. And if I go 10 years, they performed worse. So a lot of people are big on the Verizon stock because they're dividends. But when I look at the total returns, it seems like AT&T is the serious winner here. Plus, it's just good to broaden the portfolio a little bit and get into telecom, because telecom's quite a profitable game. I mean, you build a tower and run electricity through it, and you get my bill's $87 a month. So like, how everybody people have that. So, um, but yeah, so that kind of wraps up the portfolio, I guess. Um, so these are the investments that I've picked. It's good to go over why and have reasons for them, and maybe you guys can understand a little bit of why I've chosen these items. But a lot of these guys have performed really well. Some of them have not performed that well. Um, but it's at least a good point where you can say, like, there's reason for for these choices. So that's basically what we're looking at. That's the baseline portfolio. Again, thanks. This was a long video, but I feel like it's warranted. I feel like it's good to see, like, okay, this is why he's doing this. This makes sense. Like, he's not just picking a bunch of random stocks and hoping they stick. He's not picking random ETFs and hope they stick. Like, there is some logic, however, probably flawed. I'm not a financial manager, wealth manager, credit counselor, advisor, none of that. I'm just a guy. But that's basically what I'm looking at throwing my money into. And again, there's room for growth on this. Like, this could change all the time. There's other reasons why I'm investing in certain stocks too. AT&T, although it's not super profitable, it's a low cost stock, which means that I'll be able to sell covered calls on that, and we'll get into that down the road. But there's other ways that you can use your investments to make you more money. And having a lower cost of entry stock like AT&T does give you a little more access to play the market, right? So we'll be talking about that once the time comes. Right now, we've got $329. I can't be talking about covered calls. Like, that's not going to happen for quite a while. We got probably about $15,000 before that happens. So, but yeah, I really appreciate you guys sticking this one out. This is a long video. Maybe you learned something. Maybe you saw something that you liked, or found an investment that you haven't heard of, or that you're not familiar with. But yeah, just keep in mind, again, this is just for motivational and emotional and entertainment value. But it's pretty cool. It's definitely exciting. So I appreciate so far all the feedback, all the comments that I've gotten from guys, or you guys. I really do appreciate it. I appreciate the few likes and subs that I've gotten. Just, it's already motivating. So, like, thank you. And I will see you tomorrow. Oh yeah, roll the outro.